What's going on, guys? It's Brad with the Bottom Line. Today, I want to talk about three important stock market lessons for people just beginning in the market. Now, these are lessons I have learned in my 3 years of experience in the market. I've learned them the hard way, and they've cost me thousands of dollars. So, if I can pass these on to you and save you the time and money, I would love to do so. Now, I'm not saying these are the only mentalities that will make you money in the market, but I would argue that these give you the best chances for long term success in the market. So, at number one, we have to know what you are investing in and not to just take advice blindly. So, if you see someone on YouTube, even if it's me, someone on CNBC, or just hear your friends talking about investing in a company, please do not get FOMO and just go and buy a position in that company because it's the hot stock of the month or the week. You might make money by doing this, but you also can get burned very bad by doing this. The reason is if you don't do the research and work to know why you are entering a position, whether that's the value of the company or the growth story it has, then as soon as times get tough and prices start to fall, instead of having that underlying conviction in your investment and holding on or averaging down, you're going to be more likely to get shaken out of your position and sell at a loss. Number two is to not immediately pour all of your money into a position at the start. Learn to buy the dip and average down. This is a huge one. I can't emphasize this enough. The picture on the left paints it perfectly, because everyone says to buy the dip. Everyone says to buy low, sell high. However, I promise you, when the markets are crashing every day or your stock is crashing every day, it's not so easy to do that. It's easier said than done. It just seems like there's no light at the end of the tunnel and it's never going to rebound. However, if you can learn to take advantage of these opportunities, your returns are going to be much greater in the long term. Now, I am not saying to go buy trash stocks just because they took a dip. These have to be companies that you've done the work and research on and believe in long term. Looking at Facebook on the right, this is a company I felt was beaten down way too much of a market overreaction. And say, for example, you poured all of your money in on that August dip, you would be at a cost basis of about 170. However, say you average in at these positions here, about a quarter of your money each time, your cost basis would be closer to 150. So with the price now at 164, had you poured all your money in at the start, you would actually still be red on your position. However, had you averaged down, you actually would be green on your position a substantial amount. So that shows the power of cost averaging down. Now, the price is not always going to go down after you buy. Sometimes it's just going to keep going up. And that's why you should still make sure that your first lot, your first purchase is still a substantial amount of money. So if the price keeps going up, you are still making a good return. And number three, and that is to have a long-term view of the markets, to learn patience and control of your emotions. This is going to help you to not panic sell and to take advantage of great deals. So part of the reason I lost a lot of money in my early years in the market is I thought I could predict and time the market. I thought I could predict how investors were going to perceive news and information, or how algorithms were going to trade the market in a given day. Now, honestly, you can be right about, something on an earnings report and the price will move in the opposite direction of common sense. So, maybe some people can get this right, but at a certain point, I realized I was fighting a losing battle and that I was better off adopting a long-term strategy. And as soon as I did so, I noticed immediate success. So, the markets move in cycles. This picture here paints out the cycle of investor emotions. You have your initial optimism and excitement leading to a point of euphoria. Now, this is where you have the most risk because you are at overextended price levels and expensive valuations. So as soon as some anxiety and fear sets into the market, you are going to see declines in prices and leading to the bottom there at depression. And you're only depressed had you bought in at that euphoria stage, but there at the bottom is where you have the most financial opportunity. So if you are able to hold capital on the side and buy up at these levels, you have the greatest opportunity for return. You have the lowest downside risk and the greatest upside. It's funny just because, anywhere else you see sales at a store, it's a good thing. But in the stock market, if you see a stock down 10, 15%, a lot of people tend to run away. So if you can flip your mindset and be those that purchase at these prices instead, ultimately you are going to experience much greater success in the market. So guys, the bottom line, the stock market is a wild and unpredictable place. If you do the work and the research and you have that knowledgeable conviction in your investments, patience and control of your emotions, it's going to take practice, but if you can do that, you are going to be successful in the market. Guys, comment below if you have already learned these lessons before, or if you learned something new in this video, if it's something you're going to take into practice moving forward. If you enjoyed the video, please smash that like and subscribe button. One thing to know, I am not a licensed investment advisor, so please consult a professional for any investment decisions. This is purely for entertainment. Thanks for tuning in, and I will catch you in the next video.